Hi, I'm Chuck Inglefield of Inglefield Retirement Solutions, and this is my economic update for the second quarter of 2026. And there's quite a bit of news happening since we did our last economic update, the primary thing being the war in Iran. So the agenda for today is we're going to talk about the economic impacts of the war. Then I'll transition to talk about the U.S. economy specifically. We'll talk about stocks as we always do, and then we'll wrap up with a segment I call Focusing on What Matters. So let's start with the economic impact. We're going to talk about the stock market's reaction to the war, the impact on inflation that might be caused, and then how the Federal Reserve is pivoting to adjust for that impact on inflation. So the war started on February 28th, and there was an immediate pullback in the stock market, as is typical of geopolitical events. In fact, you see the S&P pulled back ultimately 8.5%, and the NASDAQ pulled back around 10%. They've both obviously recovered since then. So you can see the S&P up 11% from the bottom, and the NASDAQ up 18% from the bottom. So it just reiterates what I mentioned in the short video I created at the beginning of the wars. You have to look through that geopolitical event towards the long term to avoid really sabotaging your returns by reacting to it. And you can see there was a big penalty if you reacted to the beginning of the war. And I want to go back and look at history again. So I want to show you some market reactions to geopolitical events going back to the Korean War. And you can see that this chart shows the S&P returns 1 year after the beginning of the geopolitical event. And in all but two cases, the stock market was positive 1 year after the beginning, and the average return is 14.2%. There were two cases where the market was lower 1 year later. Let's pull those out and talk about those specifically. So the first one is obviously the 9/11 attacks in 2001, and the market 1 year later was negative meaningfully. This actually wasn't necessarily because of the 9/11 attacks. In fact, after 9/11, the stock market closed for a couple of weeks, but by the end of the year, so on December 31st of 2001, the market actually was up 5% from the time of the attacks. So why did the market drop so much over the next year? Well, if you can remember, this is right in the middle of the dot-com bust. So it was more an economic-driven market pullback than it was a geopolitical-driven pullback. Very similar for the beginning of the Ukraine war, which is there was an immediate pullback, actually around 7.4%. But then the market recovered within about a month, but the market was down a year later. And the reason why is the Fed went on its most aggressive rate hike cycle for 40 years. So, of course, that's a big headwind for markets, and markets adjusted downward during that period of time. Again, not because of the geopolitical event, but because of what was happening in the economy. So some of you may be thinking, okay, that's great, Chuck, but this is really an event that includes an impact on energy prices. And so that may have longer lasting effects. And you might be right about that. Here are a few of the geopolitical events that energy prices were a big part of. So going back to 1973, the Arab oil embargo caused the initial drawdown of the market to be 16%. It took 42 days to hit the trough, but that was right in the middle of a big bear market, which didn't recover for 6 years. The oil price impact was 300% increase. So that was quite different than what we're experiencing today. Maybe there's a few others that are closer, a couple others that are closer here. So when Iraq invaded the oil fields of Kuwait in 1990, it took 50 days before the market bottomed out, and it was almost a 16% drawdown. Took just over 4 months before the market had recovered. Oil increased by 90% in that occurrence. Then we had the Ukraine invasion, which happened in 2022. The market reacted quickly there, but it bottomed out 17 days later, only a 7.4% decline. And recovery time fully was 27 days, so less than a month. Brent crude increased by 59%, which puts into perspective what's happening now. So when the Iran war started, the initial pullback in the markets, frankly, was 23 days and averaged the S&P and the NASDAQ down about 9% and took 34 days to get back to where we were before the war started. Depending on the day, Brent is up about 73% before it was from where it was at the beginning of the war. So the longer the war lasts, the more an impact that energy prices are going to have on the economy. And we'll talk about that next. But right now, I saw this cartoon. I thought it was pretty apt. The new long line at the gas stations, people in line getting loans. And, last time I filled up, it was over $5 a gallon. And that was pretty shocking to see. My sister paid almost $6 a gallon up in Michigan. So there's clearly going to be an impact, and that impact is going to be inflationary. So let's take a look at inflation because we just got the March numbers last week, and there was a jump in inflation. So we look at this trend over time. You can see back in 2022 where we saw inflation peak at 9%. It's been coming down steadily since then, closer to the Federal Reserve's 2% target, but we're not there. But something interesting happened in March, which is inflation jumped from 2.4% up to 3.3%. So a big jump. And if you look closer here, I've pulled out the March data, and the green bar here shows that that was almost entirely due to energy. In fact, entirely due to energy, not almost. So it will have an impact over time that will be inflationary. So if the war lasts longer, these higher energy prices last longer, we're going to see that echo through the economy. That pain is not spread evenly because we are more energy independent here. We're not feeling the effects as much as some of the emerging market countries like India are feeling the effects of higher energy prices. So hope is that the war ends sooner and that the oil prices begin to come down, and that will make things a little bit easier for the Fed because things have changed for the Fed. They had the meeting last week and they said they're going to hold rates steady. This is because they have a dual mandate. One, to make sure the job market is healthy. Two, to keep inflation in check. And right now the job market's okay, so inflation is really their focus. And the bond market has adjusted to what's happened over the last month. And when we did our economic update in January, the bond market was pricing in 2 Federal Reserve rate cuts of 0.25% each in 2026. Now the majority of analysts out there think we're not going to see any rate cuts this year, and I tend to agree with them because we are not seeing the full impact of the higher energy prices yet. And as I said, the longer they're around, the more of an impact they're going to have. So a lot of this is a wild card based on what's happening with the Iran war. A lot of things we don't know, and we'll have another economic update in the next quarter. Hopefully we have more concrete information and understanding of the trajectory at that point, but that's where we are at the moment. So now let's transition to the U.S. economy, and we're going to look at GDP. Is the economy growing? We'll look at jobs. We're going to talk about consumer sentiment and then consumer spending, which is a big part of economic growth. So we've got the GDP numbers for the first quarter. Last week, it came in at 2%, which is a jump from where we were in the fourth quarter of 0.5%. The 0.5% was really due to the government shutdown in the fourth quarter of last year. And frankly, all of the GDP numbers last year are a bit distorted because of the imports and exports that were kind of way above or below their averages based on the tariffs. So companies were trying to front run the tariffs and replenish inventory. And so that really distorted GDP numbers. I think we're going to get more normalized GDP now, but 2%, it's an okay number. It's not great. It's not bad. It's right at the trend line. So that's good to see. LPL Research projected 2.1% GDP for 2026. So they seem to be right on target for the moment. If you've watched these economic updates in the past, you know I like to look at leading economic indicators. And one of my favorites is the Purchasing Managers Index. And as a leading indicator, it really gives us a glimpse to what some of the private sector is thinking about what's happening with their businesses. I usually show the chart, but the chart's just getting too confusing or too busy. So I want to just show you the numbers here, and let me simplify this a little bit. So for manufacturing, which is 1/5 of the economy, uh, the number came in March at 52.7. What does that mean? Well, if the number's over 50, it indicates expansion, or these companies are expecting their business to expand in the future or in the near future. And you can see the number held pretty steadily at 52, which is up. It was below 50 for most of last year, so that's good to see. Now, non-manufacturing or services, which is 4/5 of the economy, solidly over 50 at 54. It ticked down in March from February, but that's still a solid number. So the PMI's, Purchasing Managers Indexes, are not indicating a recession on the horizon. Some of this will be impacted by how long the war lasts, and they start to see that play a part in their profitability and how they manage inventories and how much cost might get passed through or absorbed, and how much they might see orders drop because consumers are worried about their discretionary spending. But consumers are at this point where, frankly, in a job market, they're doing fine. Unemployment's at 4.3%. Those are still historic lows. Going back to the 50s, you can see that we're at pretty good shape for jobs. And the job market's plugging along. It's not super strong, not weak either. There's 178,000 jobs added in the first quarter. So we're seeing more jobs added than we're seeing layoffs, which is great. The nice part about this is it allows the Fed to focus on inflation, and that's why they're holding interest rates steady. I haven't heard anybody say they're raising rates yet. I wouldn't count that out entirely if the war lasts much past the third quarter of this year. So jobs are okay. How are consumers? They're very gloomy. So the consumer sentiment survey done by the University of Michigan came in at 47.6. What's important about that is it's the lowest reading in the history of the survey. So it's a record low, which means consumers are not feeling very good about the economy. Part of that is their expectations around inflation. So consumers expect over the next year inflation to be 4.7%, which is a lot more than the 3.3% that we're seeing today. Why that's an important number to understand is because that impacts consumer behavior. So if consumers are thinking, hey, things are going to cost a lot more in 1 year, I better tighten my belt a little bit, build my cash reserves so I can afford those things without having to compromise lifestyle or just have some dry powder. If some things come up, I need to replace my HVAC system and it's going to cost a lot more in a year. It definitely will impact behavior if that's the expectation. Now, that's theory. In practice, you know, America's a great country. We love to spend money, and consumers are still spending money. So you can see that retail sales here holding steady to a nice pace of what we saw really going back to the early 2000s, mid 2000s. So consumers are saying they're gloomy, but they're out there spending money. So 2/3 of economic growth is based on consumer spending. And there's something interesting happening with the consumer spending numbers right now. And I've referred to it in the past. It's called the K-shaped economy. And you'll maybe hear about that in the news as well. But the idea behind the K-shaped economy, as you see here, there's one line going up and one line going down. And the line going up is the people with the higher net worth than the line going down. And it really depends on your zip code, your employer, your 401k balance, if you own property or not. And it's created a real divide as far as the experience of these higher energy prices and how it's impacting people's spending. So let's take a look at the top 20%. This is the line going up. This is the people that own stocks, they own real estate, sometimes they own businesses. The average net worth of the top 20% is $1.92 million. To reach the top 20%, your net worth has to be $892,000 or higher. So most of you watching this video are falling into this top 20% group. The bottom 80% has an average net worth of $110,000. And so when you see inflation hitting 3.3% and then gas prices hitting $5 per gallon, the bottom 80% are going to feel this a lot more than the top 20%. it will impact you from the standpoint you'll read the headlines. It's not going to impact you as much as far as consumer spending goes. And what's interesting here is 80% of the consumer spending is coming from this top 20% group. That's why I think consumer spending is holding up, because the top 20% group really hasn't changed their behavior. The bottom 80%, which is the majority of the country, is having to change their behavior and make adjustments to pay for the higher energy prices, what we've seen also in higher grocery prices. So that's part of why consumer spending has held up so much. There's also this thing called the wealth effect. So the top 20%, again, they own portfolios, they own real estate. You've seen your house values go up. You're seeing your household net worth at record highs. And so even though things cost a little bit more, it's not really changing your behavior as if you're in that top 20%, like it is the bottom 80%. That is what we call a great wealth divide, and it's gotten wider and wider over time and has created suffering on the bottom 80% where the top 20% aren't feeling it. There's probably some policy implications that are going to come into play about that at some point, because to have a strong country economically, you have to have a strong middle class, and it seems like the middle class has continued to shrink over the last couple of decades. That said, even when any of us go to the gas station, I think we all feel like this a little bit. But as I mentioned, some of us feel like this a bit more than others. So let's take a look at the percentage of consumer expenditures on energy. If you look over here on the left, the bottom 20% spend 17% of their pre-tax income on energy. The top 20%, it's 2.7. So as I said, the top 20% are seeing the headlines and seeing the gas prices, but they're not adjusting their behavior at all because it's just not that big of a portion of their budget. That's why I think the K-shaped economy is worth kind of keeping in mind, because if the top 20% start to feel the pinch or start to change their behavior, economic growth is definitely going to be impacted. I think the longer the war goes and the more you see higher airfare prices, travel prices, and so on, you'll start to see that behavior of the top 20% change a little bit. Let's turn our attention to stocks. Stocks are hitting all-time highs. And you might be wondering why that is with all this news that we're seeing. And there's a number of reasons. We're going to take a look at profits and earnings growth. We'll take a look at valuations. And then again, we'll talk about tariffs, which is something I thought we'd be spending a lot of time on this quarter, given all the big news. We did this in January, but frankly, it's almost a footnote right now. So stocks are reaching all-time highs, and there's a pretty solid reason for that. If you look at this chart on the right, you'll see profit margins of S&P 500 companies are setting records. Companies are doing very well with regard to profit margins in this economy, and that would suggest that stock prices would follow suit. It's not only profit margins, but earnings growth has been solid. I want to look at this bar chart, but I'm going to make it a little bit easier to read by focusing on the last few years. So last year, earnings grew by 13%. Projections for 2026 is we will see 19% earnings growth, 2027, 16%, 2028, 11%. Those are very solid numbers, and stock prices ultimately are driven by earnings. So when you're seeing earnings grow at these levels, you're going to see that reflected in stock prices. Whether there's short-term fluctuation driven by geopolitical events, frankly, the stock market always goes back to value earnings, and we'll see prices reflecting that. So now that we're hitting all-time highs, some of you might be wondering, wow, are the valuations too rich right now? So this chart I show every quarter, it just shows the valuations on stocks versus the 30-year average. So at the end of April, the forward price earnings ratio was 20.9. That's down from over 22 just a couple months ago. The average over the last 30 years is 17.2. So you might say, okay, we're overvalued versus history, but it's not so much that things are so lofty that the stock prices aren't going to reflect those higher earnings. I mean, those higher earnings are so solid. If those projections come through, you could argue you should also have higher valuations in this market, and that's where you are. You can see you can spend quite a bit of time above that top line, which is one standard deviation away from the average. You can spend a little bit of time below that bottom line as well. Frankly, when stocks are where they were, say back in '08, it's time to back up the truck and, load it up with more equities in theory. And when it's above the top line, you might think, oh, things are getting too expensive. But frankly, when you look at earnings, they're not too expensive. And you might say, well, gosh, stocks are hitting all-time highs, but the valuation number went down. Why is that? Well, the forward price earnings ratio, part of the formula includes earnings. So as earnings go up, the valuation can come down. It's not just prices that have to come down to lower valuations. Earnings can go up, and that also lowers valuations, which is exactly what we're seeing right now. Okay, I said I was going to talk about tariffs. The big news about tariffs was the Supreme Court overturned those since we last did our economic update. We're seeing that impacted here. Thought that was going to be huge news. Relative to everything else, it's not. But this is a really hard chart to read. But I just want to show the orange line here is the effective tariff rates back before or when they were first implemented. So it was 30%. And then in February, right before the Supreme Court overturned them, the effective rate was close to 16%. And now, after them being overturned, they're just over 10%. So their tariffs are still coming in line. In fact, there were more tariffs announced last week on foreign-made autos, 25%. But you still have to go back to the 1940s to see tariffs this high. And the challenge here is tariffs can be inflationary. When you pair that with the higher energy prices also driving a tailwind towards inflation, it makes things really challenging for the Fed. So here's where the Fed is right now. I mean, they really have the tiger by the tail, we hope, right? But it's just moving so quickly, and there's so much unknown that inflation, as it jumped last month, could continue to do so. So hopefully the energy prices level out, start to come down, so it makes the Fed's job a lot easier. But a lot remains to be seen. Over the next quarter, I'm sure we will have more to say and our economic update in Q3. All right, so let's wrap this up. They said, when you do a presentation, tell them what you're going to tell them what you want to tell them, and tell them what you just told them. So this is the summary. What we said is the Iran developments, they're going to echo through inflation, interest rates, GDP, just a lot unknown in that area right now. But a recession is not currently on the horizon based on all the other economic indicators. Consumers are still holding up at the top end. That's good for economic growth. Let's hope that holds. And then stocks are looking healthy based on earnings and profits. And that should begin to taper over the next couple years, but it is justifying these higher valuations. I'd like to conclude with a section I call focusing on what matters. We talk a lot about the economy and money, but there's a lot more important things than that, and that's what this section is all about. So, I know that some of you are feeling a bit of caution based on the fact that, frankly, costs are rising almost across the board for everything, and it might make you pause to think about how you spend your money or if you spend your money. So I'd suggest maybe consider shifting the question. Shift it from what can I afford to do to what can I not afford to miss? I appreciate you watching till the end, and we'll see you next quarter.